Okay. Good morning, everyone. So today we have our fourth session on consolidation. Uh, I think I had left you guys with one question as just to try out for your homework. Okay. We had done some partial adjustments and then I had told you that the remaining adjustments you can start. I hope you guys have tried it out. I had also given you the broad answers. Okay, so have you guys tried it out? Yes, good morning, Shailendra. Yes, are you guys there? Have you tried it or not? Okay, or we quickly run through the workings. Okay, we quickly run through the workings so that we can see where. Okay, oh, Nidhi has confirmed she has received, I mean, she got the answer. Anybody having difficulty? Otherwise, I can proceed further. Did you get 1,68,000? Okay. Just to cross confirm your answers. Okay. I will write the breakups. You can just cross check your answers. Property, plant and equipment is 95,900. Just check. Okay. Because this is a homework, I'm moving from the answer and then I will touch the pain points. Okay. There is no goodwill on acquisition. What arises is a capital reserve. Financial assets, investments and loans. Okay. Well, these items also are not there. No, they are. Okay. Now current assets, you're having your inventory of 32,100. Trade receivables of 33,000 and cash equivalents of 7,000. Okay. Equity capital 1,10,000. Other equity 36,910. Non-controlling interest 5,590. Okay. And trade payables 15,500. Anybody having any difficulty in any of the top of these this thing, just let me know. I can solve it up again for you. Okay. But if you have if you have got these answers, then we will proceed to the next concept. Good morning, Rashmi. Good morning, Manini. Did you get these answers? Yes. Or do you need me to do the working ones? If you tell me, I'll do the working ones. It's not an issue. Okay. शैलेंद्र आपने किया? कोई तो बोलो. नहीं किया तो बोल सकते हो, कोई बात नहीं, हम लोग कर देंगे अभी. I'm waiting for answers. Do I do it or did you get the answers? Okay, fine. All right. So we come back to the question. Okay. All right. So this was question number 47, which I had left you with. Okay. So we have done the balance sheet. We have drafted, we have put the respective items in the places. Okay. Now we have also given the impact of the inter-unit eliminations, intercompany eliminations on account of inventory, the unrealized profit eliminations. Okay. So now let us proceed to look at what other adjustments are there in this question, and then we shall try to solve it. Okay. So at least till now, standalone A Limited, these figures, I think everybody should be clear. Okay. So this is at least up till here, it should be fine. Okay. So now coming to analysis of the P&L, the balance in profit and loss is 3,000. We have completed analysis of general reserve. P&L balance is 3,000. So you can note it is equal to 3,000. This is balance sheet of What is the name? B Limited. Okay. So this one, let us start to split it up between pre and post. Pre and post. Okay. All right. Have they given the balance on acquisition? Yes. It was acquired when there was a credit balance in P&L of 3,500. So balance on date of acquisition 3,500. So that means in the post acquisition period, you have made a loss of 500, which is fine. Okay. Post date of acquisition profits. It's actually a loss. It is actually a loss. Okay. Then we come to the adjustments. Okay. In determining the value of shares of B Limited, this is on the date of acquisition. Okay. Plant and machinery, which then stood in the books at 22,500 was revalued at 27,000. Okay. So in determining the value of shares of B Limited, why are you going to determine the value of shares of B Limited? For the purposes of acquisition. Answer sheet is there, no? I mean, you want the PDF, I'll have to convert and give it to you. I have to convert and upload it. Okay. But if you're solving it, then answer sheets are available. Check it on the notes or the assignment section. The blank formats are there for you. Okay. So in determining the value of shares, that means this is on the date of acquisition. Plant and machinery, which then means when? On date of acquisition, stood at 22,500, was revalued at 27,000. Okay, fine. So now let us come to our fair value adjustments working. Okay, so this is going to be first one, initial adjustment. Initial adjustment means what? The upward or downward movement on the date of acquisition. The upward or downward movement on the date of acquisition. वो तो हमें ढूंढना पड़ेगा. So you can leave about 4 to 5 lines and then we can do the recording of this. Okay. We'll first do the recording of this. Okay. Stood at 22,500, was revalued at 27,000. So we'll write this here only, then we do the subsequent one. Plant and machinery, upward valuation is happening. It was 22,500, it became 27,000. Okay, so this comes to how much? 4,500. Okay, next we move on. And furniture standing at 3,000 was revalued at 1,800. So to furniture and fixtures. $3,000 minus 1,800. So this comes to 1,200. So the net impact is a credit of how much? 3,300. Where will this figure go? To pre-reserves. Only one reserve is left now, pre-P&L. Okay. So now where will the impacts go? Plant and machinery goes in note 1. So does furniture and fixtures. Pre-P&L will form a part of working note number 4. Always have a habit of giving the note references here, not because it's mandatory or you lose marks, but it's just that you know where the first effect and the second effect will go, and you can give them immediately. Give the impacts immediately so that you don't forget. So otherwise you will start searching what is missing when your balance sheet doesn't tally. So go to note number 1 and then give the impacts. Okay, go to note number 1, give the effect. Plant and machinery is going up by 4,500. And furniture is going down by 1,200. Okay. So this is your first impact. This is your first impact. Because of this, there will be an additional depreciation in case of plant and machinery and a savings in depreciation on account of furniture. So that we will have to calculate now. And then the next effect goes to profit and loss account. You can write add, this is pre, fair value adjustment from working note 5. This is 3,300. This is 3,300. Okay. So I hope till now it's clear. Yes, let us then move on to the next part, that is subsequent adjustment. Subsequent adjustment. Okay. Now, when we look at our subsequent adjustments, it is basically talking about depreciation. The question is, sir, are we given the remaining useful life like it was given in the previous question? Answer is no. Are we given the rate of depreciation? Again, answer to that is no. So will you have to give a subsequent impact? Yes, if you can calculate. So can we calculate here? Of course we can calculate. Okay. So you are having value on date of acquisition, post acquisition depreciation. Okay. So if I consider the book value, what is the book value? Which then stood at 22,500. So if my book value was 22,500, it fell to how much on the date of consolidation? Plant and machinery fell to 19,500. That means the post-acquisition depreciation is 3,000. The post-acquisition depreciation is 3,000. How did I get this 3,000? 22,500 minus 19,500. 22,500 is the book value on the date of acquisition. 19,500 is the book value on the date of consolidation. The movement can be attributed to depreciation. Okay. Whereas the fair value, when you do the fair value on the date of acquisition, you have fair valued it to 27,000. So what will be your depreciation? What will be your depreciation? You just have to cross multiply. This comes to 3,600. This would be your post acquisition depreciation. How did I get this? 27,000 divided by 22,500 into 3,000. Just a cross multiplication. Okay. Less post acquisition depreciation already charged as per book value. You've already debited 3,000. So the additional depreciation is 600. Additional depreciation is 600. Okay. Yes. How many of you got this part? Those of you who have done, how many of you could get this? How many of you could get this? Manini, did you get this? Rashmi, Nidhi Deshpande, I think Nidhi has already done entirely. Okay. Srishti, Kaushiki, did you get? Okay, good. Okay. All right, great. Okay. So up to samjha na? So now if you understood, it's good. Okay. Soham is around. Sumit Jain, Aniket Jain. Are you guys there? Okay, done. So what will be the entry? This is your post acquisition depreciation. So the entry will be post P&L. Post P&L debit to plant and machinery. To plant and machinery. This is going to be 600. And post it immediately. Post P&L means working note 4, analysis of reserves, and plant and machinery means note number 1. Plant and machinery means note number 1. Okay. So with this background, let us give the effects now. So here, plant and machinery, it will go down by 600, and then go to your reserves and surplus, profit and loss, less additional depreciation, plant and machinery. 600. Okay, fine. All right. तो ये हो गया हमारा first effect, that is plant and machinery revaluation. Everything is done. Now only thing which is left is furniture and fixtures. Okay. So subsequent adjustment, this was relating to plant and machinery. Would you guys like to try out furniture fixtures based on the same principles? Yes, try करो, देखते हैं if you get the answer. Try करो. Try it out. Namaste, Sumit Jain. Namaste. Try it. Tell me what is the reversal in depreciation or savings in depreciation that you are getting. Great. So I got one answer. I'm waiting for others. Nidhi has given the right answer. What about the others? Okay. So book value was 3000 and current value is how much? 2500. So depreciation would be 500 based on book values. Okay. Next, fair value. This is 1800. So cross multiply. Post acquisition depreciation. 1,800 by 3,000 into 500. So that gives you how much? 300. This should have been the post-acquisition depreciation less depreciation charged at book values. Charged at book values. That is 500. So what you are having is a net savings in depreciation of 200. Okay. So what will be the entry for this? Furniture account debit to, it is a savings after the date of acquisition. So post P&L. 200, 200. Furniture debit will go in note 1 and post P&L will go in working note 4. Okay. अरे मनिनी, कौशिकी, सृष्टि, शैलेंद्र, रश्मि, सुमित, समझ में आई? Okay. So post the effects plus 200 and then the second effect in the P&L. Add reversal, or you can write savings of depreciation. This is for furniture, 200. This is for furniture, 200. That's it. All adjustments are done. Total up, this comes to 6,800 and this comes to negative 900. So split this up between parent and NCI. A Limited, we have calculated the stake as 90%, NCI 10%. Then the next one is also A Limited, NCI 90%, 10%. Okay, so 6,800 into 10% gives you 680. This is remaining 6120. 900 into 90%, 810, and this is 90. Where will the impacts go? Pre-acquisition, this goes to COC account, working note 2, I think. It's 2 only, no? In this case, yes. Okay. NCI will go to NCI account, working note 3. Where will this post-acquisition profits go? This will go to working note 1. This will go to working note 1. And what about this 90? This will go to NCI account in working note 3. This will go to NCI account in working note 3. Okay, so post in the respective positions, NCI account, you will be doing the posting. So go to your NCI account. We have posted general reserve by pre-P&L. Working note 4, that is 680. And then we are having a loss also. So to post P&L. Working note 4. Share in the loss is 90. Share in the loss is 90. Then go to cost of control account. Pre-P&L. Working note 4. 6,120. 6,120. That's it. So then you balance this whole thing. 36,000 plus 2250 plus 6120. 44,370 is the total. Minus 39,000, you are left with 5370. To capital reserve. To capital reserve 5,370. Okay. All right. Consolidated other equity में that 810 will come here. Share in post acquisition profits. Share in post acquisition profits. I will be having 810 negative because it's actually a loss. Nothing related to this. And we've already given effects for the downstream transaction. We've already given effects for the downstream transaction in the previous session. Okay, so total this up 13,000, 6,750, and this gives you 11,790. So start pulling these values in the consolidated other equity, note number 3. Securities premium, working note 1, 13,000. Capital reserve on consolidation, working note 2, that is 5,370. General reserve, working note 1, 6,750. And profit and loss, again working note 1, 11,790. So total this up. $36,910. Okay, 36,910. Total up these values now 17, 12, 29, 30,000. $58,400. 7,500. 95,900. Inventories 30,100. Trade receivables 33,000. Cash and cash equivalents 7,000. And this is 15,500. All the values are posted here. This is working note 1, 1, 1, 1. equity share capital, note number 2. Other equity, note number 3. NCI working note 3. This is note number 1. Okay. So that takes care of question number 47 for you. Any doubts now? Anybody had any doubts? Yes or no? Done? All clear. Okay. Got one confirmation. Rashmi, is it clear? Kaushiki, is it clear? Srishti Goyal, is it clear? Okay. Kaushiki also confirmed. Shailendra, आपको समझा? Sumit Jain, did you follow? No doubts. Okay. Great. So that takes care of question 47. I had also given you some small questions to do for homework. Did you guys try it out? Yes. No doubts. Okay. All right. I had given you some small questions for homework. Did you try it out? I will not want to spend my time doing these questions for you. Okay. That is why I told you to do it. These two are homework questions. Try it out. It's an ICI illustration also. We have done the adjustment already. तो ये सिर्फ उसका एक छोटा सा part है, the revision of that. So please try it out. Okay. All right. Now, okay, fine. There is one small impact on account of taxation. Okay, we will study this, but you will have to right now remember this because you have still not studied Ind AS 12 on income taxes, I believe, but it's not that difficult, okay, to remember. Why it is being done, I can only tell you when you have understood Ind AS 1, 2, that is Ind AS 12 on deferred taxes, on taxes on income. Okay, it covers current, deferred, all that. Okay, but let us just understand what this is all about, and then we will see how the impacts need to be done. So you will be doing deferred tax adjustments in your question only if two things are given. One is fair value of net assets taken over, and carrying value of net assets taken over is given. Carrying value means old carrying values. Okay. So fair value of net assets taken over should be given, and carrying value of net assets taken over is given. So in the previous question, what we just now did 47, we were given the value then. Furniture was plant and machinery was 22,500 and the fair value is 27. So you are given both the data, that is the fair value 27, carrying value 22,500. And additionally, you should be given the tax rate. Additionally, you should be given the tax rate. In the question, tax rate was not given. We ignored income tax. If it was given, we had to do the deferred tax impact. So what does the deferred tax impact tell us? We had done this, I remember in 103, I think I had made you to write this down. Okay. So deferred tax can be computed as temporary difference multiplied by the tax rate. So when will temporary difference arise? When fair value is greater than carrying value. Fair value is here. carrying value is here. Okay. So when fair value is more than the carrying value, it gives rise to a deferred tax liability, and it gives rise to a deferred tax asset in the case fair value is less than the carrying value. Okay, we have also discussed the impacts at the time of business combination. That is, step numbers 1, 2, and 3 remain the same. Step number 4, net assets will change. Net assets will undergo a change. Okay, so fair value of net assets less deferred tax liability plus deferred tax asset gives rise to fair value of net assets taken over after tax. Because of this, NCI would also change. We had studied. If it is NCI at fair value, there won't be any change. There won't be any change. But goodwill attributable to NCI will undergo a change. Why? Because my pre-acquisition reserves or net assets on the date of acquisition are changing due to deferred tax adjustments. See, my net assets are changing here. So therefore, we are going to attribute it. We are going to attribute it to the net assets on the date of acquisition. That will change, and that is why what is going to change is the goodwill attributable to NCI. Aren't these notes available? These notes are available. No, I had given them to the institute for uploading. Guys, please confirm these notes are available or not available. Rashmi, Kaushiki, Manini, Nidhi, Sumit, Shai, please confirm, are these notes available on the portal or not? Yeah, so Srishti is confirming. Yeah, Srishti, Soham, all of them are confirming. Shailendra, please check on the app or on the website. Okay, all these notes are there. Okay, please check and download. So we had done this part. Okay, calculation of NCI proportionate net assets method. So net assets after deferred tax, it will obviously change into proportion of NCI stake. So here goodwill is not attributable, but only the closing balance of NCI on the date of acquisition will undergo a change. Okay, so this is the impact based on the Ind AS 103 approach. Okay, goodwill will always get impacted as net assets taken over changes due to deferred tax adjustments. Okay, so this was the 6-step approach which we had seen in business combination. Okay, now let us take a small case of understanding how the impact will happen in Ind AS 103 as well as in Ind AS 110. Ultimately, we have to gear up to get the same answer under both the methods. So that is why I have just made this small question for you. Okay. Fair value of net assets 3,300. Carrying amount of net assets 3,000. Assume remaining useful life of net assets is 3 years. Date of acquisition 1st April 21. P acquires a 60% stake in S for 2,500. NCI based on market value of S Limited shares is 1,500. That means this is NCI at fair value. This is NCI at fair value. Okay. Now, determine the goodwill on the date of acquisition using both Ind AS 103 approach and Ind AS 110 approach. Further information, equity share capital of the subsidiary is 500 on the date of acquisition and profit and loss is 2,500. So you are given this data and then you will have to follow the 6-step model or the 110 model. So 6-step model, acquirer is P Limited. Fair enough. I don't think there is any doubt here. Date of acquisition 1/4/2021. That is also fine. Purchase consideration 2,500 for 60% stake. That is also fine. Net assets taken over. Now here we are going to have a change. Ordinarily, it would be only 3,300. Ordinarily, it would be only 3,300. But look at the notes. Look at the notes. If you are given two pieces of information, the fair value is given the net assets is given, and the tax rate is given. If these three things are there, then deferred tax institute will not tell you, please calculate the tax impact. No, it is understood that you have to calculate. Okay. So fair value of net assets is given. Carrying value of net assets is given. Difference is 300 into 30%, that is 90. It gives rise to a deferred tax liability. Why it is a DTL, you will come to know when you do Ind AS 12. Abhi ke liye just take this and go ahead. Okay. So less deferred tax liability 90. So your net assets taken over is 3,210. 3,210. NCI at fair value is 1,500, which is given. For your understanding, what I have done is I have also computed NCI at proportionate share of net assets. So this is going to be 3,210 into 40%. We have acquired 60, so NCI is 40%. So NCI comes to 1,284. So goodwill is PC 2,500 plus NCI 1,500 giving 4,000 minus 3,210 giving goodwill on the date of acquisition as 790. Whereas if you follow using NCI at proportionate share of net assets, I get goodwill as 574. What is the difference in the goodwill? The difference in the goodwill is 790 minus 574, 216. And this 216, if I am not wrong, it is exactly the difference between NCI. 1,500 minus 1,284. आप अगर ये करोगे 1,500 minus 1,284, आपको कितना मिलेगा? 216. So the additional goodwill which you are recognizing when NCI is at fair value, this additional goodwill is attributable to NCI. So 790 is my full goodwill. 574 is my partial goodwill attributable only to the parent. Okay, so that takes care of the business combination approach. That takes care of the business combination approach. Now the question arises, sir, how do we do this adjustment? How do we do this adjustment for Ind AS 110? Okay, for Ind AS 110. Okay. Okay. Soham, your query will be addressed in Ind AS 12. Okay. There is one fundamental presumption here in Ind AS, I mean in academics, okay, not in real life, that carrying value is equal to your income tax WDV. This is what is presumed here. Okay. This is what is presumed here. Because you asked it, I told it. Otherwise, I would not have told. So this is my presumption. In real life, obviously, it won't be the same. So we will be comparing fair value with the WDV as per the Income Tax Act and then determine the deferred tax asset or liability. But here, Institute does not confuse you to such an extent that it gives you three values and tells compute the deferred tax impact. So this is a underlying assumption which is there. Okay, but good, at least I got a question on that. Okay, so now coming to Ind AS 110, see, I will forget the balance sheet. I will forget the note 1, note 2, note 3, working note 1. I straight away come to working note 2 because that is what interests us. That is what ends up to interest us. That is where the goodwill is computed. So first one, investment in S gets eliminated at 2,500. Okay. Equity share capital to the extent of 60%, 500 into 60% is eliminated. Okay. Now, equity share capital 40% allocated to NCI. 40% allocated to NCI. Now we move on to the next part, that is analysis of reserves. Okay. NCI working note 3, analysis of reserves. P&L is 2,500. So we split it up. Balance on date of acquisition is 2500. Post to kuch bhi nahi hai. So this is 0. Add increase in fair value 300. Because of this increase in fair value, the deferred tax impact will be reduced by 90. So 2710 will be split up between the parent and the NCI as 1626 to the parent. So 1626 I record here, and ultimately goodwill is 574, which is the same figure as business combination approach. Okay. Even if I do NCI at fair value, closing balance is 1500. Pre-P&L attributable to NCI would be 1084. So goodwill attributable to NCI will be 216. So therefore your total goodwill is going to be 574 plus 216, that is 790, which is exactly what was our goodwill under the business combination method. Under the business combination method. Is it clear? Why DTL भूल जाओ? उसके अलावा are you clear about how the impacts will be under 103 and 110 on account of tax? Yes. Everyone, is it clear? As of now, just work at it, thinking that this is a rule that you have to follow. Okay. That if fair value is greater than carrying value, etc., etc., just think and work accordingly. Okay. क्यों DTL है, all of that I will not be touching right now because that will take a lot of our time and it's not a subject part of our discussion. होगा, आप लोग पढ़ोगे, that time you will be very clear about these adjustments. Okay, so somewhere if you have taken a printout or you are writing down somewhere, please ensure that you revisit this portion after you complete your Ind AS 12. After you complete your Ind AS 12. Okay. There is another exception in Ind AS 12, that is deferred tax cannot be recognized in respect of goodwill. Deferred tax cannot be recognized in respect of goodwill. See, goodwill has a carrying amount in consolidation, but goodwill is never recognized in income tax. Basically, your consolidation itself is not recognized in income tax. So the carrying amount of goodwill will be what you determine. Whereas, so if I have to put it in perspective, okay, what happens is I'll be having a situation like this. Okay. I'm keeping it very simple. Don't say, sir, DTL already hai, etc., etc. Okay. Net assets 3210. To bank purchase consideration 2500. To NCI 1284. This gives me a balancing figure of 574. Yes, which I call it as goodwill. Which I call it as goodwill. Okay. Now see, this goodwill will be there only in financial reporting. If I go to income tax, in income tax, there is no concept of group assessment. There is no concept of group WDV. There is no concept of group carrying amount. So for financial reporting, this has a value of 574, whereas for tax purposes, it is never recognized. So it gives rise to a nil balance. It gives rise to a nil balance. So this gives rise to a difference of 574. This gives rise to a difference of 574. In terms of what you can say, the logic that we have applied here, this becomes my tax base. Okay, this becomes my tax base, which is 0. This becomes my carrying amount, which is 574, or fair value. You can call it as fair value because goodwill is always at fair value. So now in terms of our understanding, fair value in our case is 574. carrying value or tax base is 0. So it is greater. So it gives rise to a deferred tax liability. It gives rise to a deferred tax liability. अगर हम लोग DTL record करते in respect of goodwill, 574 into point, what is the tax rate they have given? Tax rate is 30%. Okay. Into 0.3, तो 172 rupees का goodwill होता. So what would happen is basically it ends up like this. You will recognize to DTL 172. If this is 172, भाई ये 574 कैसे होगा? This will increase by 172. So this becomes 746. If this becomes 746, this cannot be 172. It will be 746 into 0.3, 224. If this is 224, this cannot be 746. This will be 224 plus 746, 970. This is 970. This will change. So it goes into a circular reference. It ends up going into a circular reference. So when you study Ind AS 12, that time you will see that there is an exception to recognition of deferred tax liability. वहां पे specifically लिखा हुआ है deferred tax impact in respect of goodwill arising out of consolidation will never be recognized. Will never be recognized. Why it won't be recognized? Because it is giving rise to a never-ending loop. It is giving rise to a never-ending loop, and that is why we cannot see the end of it. Okay, both are balancing figures of each other. Okay, you get one figure, the next one is 30% of that. That will change. It goes into a never-ending cycle, and that is why when you see Ind AS 12 exceptions, you will have deferred tax in respect of goodwill arising on consolidation will never, on business combination, will never be recognized. Is it okay? Have you understood this brief discussion? Did you understand? Yes. Have you understood the deferred tax, why it is not recognized, how it is recognized, what are the impacts which are going? Yes. Have you understood that, or did you not understand that? Respond, please. Srishti has confirmed. Others? बस उतना काफी है, अभी के लिए उतना काफी है. एकदम बारीकी से नहीं चाहिए, ऊपर ऊपर से भी समझा तो भी ठीक है. You can always revisit this lecture after Ind AS 12. That time I'm sure you are in a position to appreciate this. Okay, there is something known as a tax base in Ind AS 12. So I have written that word here in your notes. Okay, I have written that word here in your notes. Carrying value is presumed to be your tax base. Okay, presumed to be your tax base. Once you know what is your tax base, that time you will be able to understand this correctly. Okay, otherwise I think abhi ke liye this is more than enough. For now this is enough. Okay, now for 31st March 2022, for 31st March 2022, okay, how the things will start to move. See, ये तो हो गया on the date of acquisition. But याद रखो, Ind AS 110, तो you get the balance sheets after the date of acquisition. So how will the things start to move? Okay, so that starts getting very interesting. P&L as on March 22, that is 1 year after acquisition, is 2,800. Okay, balance was 2,500 on 1st April 21. So the profit for 21-22 is 300. This is clear. Okay. Fair value adjustment. We had an upward fair valuation of 300. Yes. If you look at the problem, 300 net assets, fair value 3,300. Sorry, 3,000 carrying amount and 3,300 fair value, upward valuation of 300. So as we have studied, the movement in fair value on the date of acquisition will be taken to the profit and loss pre-reserves. Okay. So add fair value adjustment 2,800. The additional impact is the deferred tax. So 2,710, 1,626 and 1,284 will be the split, which is exactly what we did in this case, which is exactly what we did here. So ultimately your goodwill will not change. So I have written COC remains unchanged, and as on 1st April 21, NCI also remains unchanged. So I think this part should be fairly clear to you. This part should be fairly clear. We move on to the post acquisition. By post acquisition, what is going to happen? You are given useful life of net assets is 10 years. So you will be having an additional depreciation of 30. You will be having an additional depreciation of 30. इतने से काम नहीं बनता है. 300 minus 30, 270. You cannot split that 270 immediately. Array, if my amount goes down, obviously I will have a reversal of my deferred tax recognized earlier also. And that reversal, I will end up booking it as a reversal of DTL of 9 rupees in the current period. Okay. Sir, फिर से बताओ हमको समझाने. Okay. See, date of acquisition, what is your value? Sir, value is 3,300. Okay. Date of consolidation. Wait, 1 second. 1 second. ऐसे नहीं चलेगा. Okay. Date of acquisition, date of consolidation. Carrying amount, fair value. Difference, DTL. Carrying amount of net assets was 3,000, fair value 3,300, difference was 300 into 30%. This gave you 90. This gave you 90. Now, on the date of consolidation, carrying amount will obviously go down. Yes, because of depreciation. You would already be recognizing it at, wait 1 second. Okay. Carrying amount would get depreciated to 2,700. Yes, this is 3,000 minus 300. Correct? Fair value would get depreciated as 3,300 minus 330. So this gives you how much? 3,300 minus 330. So this comes to 2,970. What is your difference? 270. On 270, what is the deferred tax? 81. So now if you see the deferred tax, it was 90 earlier on the date of acquisition, whereas on the date of consolidation, it actually falls to 81. So there is a reversal of DTL. There is a reversal of DTL to the extent of 9 rupees. This reversal of DTL is what is booked here. This reversal of DTL is what is booked here. Okay. So now this 279 will be split between parent and NCI in their stakes, in the ratio of their shareholding. Okay. And it will accordingly go to the respective working notes. Is it clear? Yes, all well. So these are the changes which will happen on account of deferred tax. These are the changes which will happen on account of deferred tax. So now what I want you to do is, I had given you these two questions for homework. I want you to solve them without ignoring tax impact, Okay, so try these questions and then you will be in a position to understand. Okay, reversal will be of the DTL amount as well. Okay, reversal will be of the DTL amount also. Okay, see, one is the additional depreciation will be coming, which reverses the increase. Because that is reversing, you will ultimately have a reversal of the DTL also. Okay, this value 90 will ultimately turn to 0 at the end of 10 years. Okay, so ये हो गया मेरा deferred tax का what you need for consolidation. Okay, I don't have anything further to explain on this. Okay, so please try this particular what you can say problems with the tax impact. I think you should be clear of it. Okay, all right, coming to the next part, sir. These two entities, parent and subsidiary, these two entities are different entities who are preparing their own financial statements, correct? Because they are preparing their own financial statements, they will be following their own accounting policies. So when they are following their own accounting policies, and when such accounting policies are different, can I just go on adding them line by line? There is a guidance that Ind AS 110 provides in this regard. See, it's quite possible that, for example, the inventory of the parent is valued using the what you can say weighted average method, whereas here you are valuing using the FIFO method. So that is an example of a different accounting policy that is being used. So now the question is, can I directly add it? So Ind AS 110 tells us that uniform accounting policies should be followed. By the parent and the subsidiary for like-to-like transactions. That means for similar transactions. So the question that you will be asking is, are accounting policies same for similar items? If the answer to that is yes, then consolidate without any restatement of subsidiaries financials. Are accounting policies same for similar items? If the answer to that is no, then whose financials will you change? Will you change the parents or will you change the subsidiaries? Okay. Will you change the parents or will you change the subsidiary? Obviously, subsidiary will change the accounting policy to bring it online with the parent. So restate the financials of S Limited prior to consolidation in line with P Limited's accounting policies in accordance with Ind AS 8 principles. Okay. Subsequently proceed with the consolidation. This adjustment is mandatory. Choice nahi hai aapke paas. Okay. Important is like to like or similar transactions. Transactions are different, but you are following different policies for them, then it is permitted to add. For example, okay, you are having Reliance. It will be having inventory of crude oil, petroleum. It will be having its subsidiary Reliance Digital. Okay. So now the parent company, Reliance Industries, follows weighted average method for the inventory of petrol, crude oil, etc. It has a subsidiary S2, which is dealing in electronics, for which it follows FIFO. Do you need to restate S2's financials according to the parent? Answer is no. Because electronics is a different class or a different set of items and petrol is a different set of items. So S2 need not restate its financials. But suppose the parent had a subsidiary S1 which held inventory of petrol using the FIFO method. If that is the case, then S1 will have to restate its financials. S1 will have to restate its financials. So this is one area where students get confused. So you will have to look at what is the nature of the inventory we are talking about. If they are same or similar, then they have to follow the same one. If they are different, then it is perfectly fine to add it line by line, Okay, so that takes care of S1, S2 parent. Coming to depreciation methods, well, depreciation methods are regarded as accounting estimates and not accounting policies. For example, parent follows straight line method, subsidiary follows written down value method. Do you have to align the WDV of the subsidiary in line with that of the parent? Answer is not needed. जो कर रहे हो वो करो. Just add it up and that will amount to what you can say. You can follow different methods of depreciation. Restatement of subsidiaries financials is not required in such cases. Okay. So that was all about different accounting policies. Is it clear, everyone? Is it clear? Yes. Any doubts? यूनिफॉर्म अकाउंटिंग पॉलिसी समझा अपने को? ऑल राइट, तो ये हो गया हमारा एडजस्टमेंट नंबर 5. Coming to adjustments, 2-3 small adjustments are there. It's only theoretical, okay? But I think you should be in a position to understand, okay? Different reporting dates. Is it possible that the parent and the subsidiary will have different reporting dates? Definitely it is possible. Okay. So suppose your parent company is located, your parent company follows the financial year and your subsidiary follows the calendar year, or vice versa. Okay. Parent follows the calendar year and subsidiary follows the financial year. If that is the case, can I do a line by line consolidation? Answer is kaise karoge? Bhai, date only is different, na? The dates only are different. How are you going to consolidate? Array, if you want to consolidate, you need balance sheet as on March X2, balance sheet as on March X2 for both the entities. You cannot have balance sheet on March X2, December balance sheet, and then go on adding saying that humne consolidation kar liya. Hari, what did you consolidate? That is a meaningless consolidation. So the standard here gives guidance. The standard tells if the difference between the closing dates, is up to a period of 3 months, then different reporting dates means parent, subsidiary follow different reportings. For example, you are a parent company in India and you follow April to March. ये आपका financial year है. You have incorporated a subsidiary in United Arab Emirates, UAE, and there you follow the calendar year Jan to December. Okay. And now, as on March 31, you want to prepare the consolidated financials. The question is, can I add March with December? Both are date of consolidation only, not DOA. Okay. So now the question is, can I add March and December directly? Answer is no. कोई बच्चा भी बोलेगा, you can ask 11th standard person also, he will tell sir आप add नहीं कर सकते because periods are different. So the standard gives guidance in this regard. Standard tells us if the difference is up to 3 months, that means you can see March to December up to a period of 3 months. If this difference is up to a period of 3 months, if this is up to a period of 3 months, then what the standard tells is, for this 3-month period, we call this as the intermediate period. Intermediate period. What will you do for the intermediate period? Material events should be adjusted. Prepare a restated balance sheet incorporating the effects of all the material events. Okay. Do I have to prepare the entire balance sheet again? No. Difference खाली 3 महीने का है. You identify what are the material events. Give effect to those material events. And then prepare a restated balance sheet and consolidate using that balance sheet. Sir, difference अगर 3 महीने से ज्यादा हुआ तो, if difference is more than 3 months, then बेटा आपके तो लॉटरी लग गए. आपको पूरा बैलेंस शीट बनाना है, पूरा फाइनेंशियल स्टेटमेंट्स बनाना है, with all the notes, CFS, profit and loss, balance sheet, everything you have to prepare. And you cannot say I will only adjust for the material items. Okay, तो आपके लॉटरी लग जाते हैं अगर आपका डिफरेंस more than 3 months हुआ तो. More than 3 months हुआ, you will have to prepare the detailed financials basis which you will have to consolidate it with the parent. Is it understood? Is it understood? Yes. Have you understood both of them? Yes or no? Clear. Okay, fine. Manini, did you understand? Rashmi, Nidhi, Shailendra, Sumit, Soham, all clear? Okay, fine. Now we move on to the next part, which is already something which you are aware of, Okay. Intercompany eliminations. Okay. So debtors, creditors. Do you have to eliminate? Yes. You know it. Okay. एक ही balance sheet में हम debtor भी नहीं रख सकते, creditor भी नहीं रख सकते. We have to end up eliminating them. So eliminate these balances by giving effects in note 1 adjustment column. We have done that already. आपको पता है. Okay, 9,000 in the last example that we solved. 9,000 we adjusted in debtors, 9,000 in creditors. Occasionally there may be a difference in the balances. This could be either goods in transit, cash or check in transit, but such data will be given in the question. Okay, so that is what is debtors, creditors. If you remember, you used to do the same thing in your branch accounts also. Okay, you're coming from intermediate, so you would have studied departmental and branch accounts. So in branch accounts, you had that concept of goods in transit, cash in transit. Okay, so same thing applies here also. Intercompany loans and advances. These also will be eliminated. If interest is not recorded, you will separately pass an entry for interest prior to elimination. Okay. है ना, क्वेश्चन है, मुझे ये एडजस्टमेंट कंप्लीट करने दो, उसके बाद हम लोग मोर देन 3 मंथ नहीं है, अप टू 3 मंथ का है. ओके, मोर देन 3 मंथ्स यू डोंट हैव अ क्वेश्चन, अप टू 3 मंथ्स वी हैव अ क्वेश्चन. वो आपको होमवर्क के लिए देने वाला हूं मैं. ओके, all right. Now coming to the next part. So these two things you are fairly conversant with. ये तो आप हमेशा से करते आ रहे हो. You will be able to do it. The next one is a little different. Okay. Intercompany debentures or preference shares. Interest will come in both, no? Interest will come as an income for the entity giving the intercompany advance. It would be an expense for the company receiving the advance. How will I present it in the consolidated financials? Well, you will have to eliminate the interest. You will have to eliminate the interest. Okay. Because it is representing as income for one entity and expense for the other entity. So when consolidating, it will be eliminated when you prepare the consolidated profit and loss account. Okay. तो ये हो गया मेरा intercompany loans. Now we move on to intercompany debentures or preference shares. Okay. See, the issue with debentures or preference shares is that these are normally traded securities. आपको market में जाके खरीद सकते हो, अपना खुद के debenture भी खरीद सकते हो. Okay. So the parent wants to buy the debentures of its subsidiary or vice versa. Okay. So if it has to buy, what it will do is it will go to the market and then place an order for the debentures and then acquire the debentures. Now the market price will be quite different from the face value of these instruments. वो same थोड़ा ही होगा. Market value of the debentures will be quite different from the face value of the debentures. But fact is what? Fact is, say parent has issued debentures and subsidiary is holding some of those debentures. That means it becomes kind of an intercompany debt. It becomes something like an intercompany debt. So if these instruments are classified as financial liability, which will be assumed always, unless otherwise it is given. So if it is classified as a financial liability, it will be eliminated through note 1 with the difference, if any, taken to consolidated P&L, with the difference taken to consolidated P&L. Okay. Why consol P&L? Say for example, you purchased debentures with face value 1 lakh for 1,10,000. When you start consolidating, 1 lakh of the debenture loan is payable to the subsidiary. So parent will tell, अरे हम लोग में कौन सा रिश्ता है लेन देन का? You cancel it and I will also cancel it while consolidating. But the subsidiary will say, wait a minute, रिश्ता कैसे नहीं है? रिश्ता है. मैंने 1 लाख का डिबेंचर 1,10,000 में खरीदा है. I have purchased debenture worth 1 lakh face value at 1,10,000. So that additional amount which is there, it is like similar to a loss on settlement. For 1 lakh liability to be settled, you have paid 1,10,000 in the market. So that will be eliminated through note number 1 with the difference, if any, taken to the consolidated P&L. So the entry will be like this: debentures account debit, face value, credit investment in debentures, the difference goes to consolidated P&L. The difference goes to consolidated P&L. Okay. Is this part correct? Clear? I have done this. Is this part clear? Kaushiki has confirmed. Others, Srishti Samja, Manini, Nidhi, Rashmi, Sumit, Shailendra. Did you guys understand? Clear. Okay, fine. All right, good. The problem arises if these are classified as equity. They are convertible debentures, convertible preference shares. If that is the case, then how am I going to adjust? Okay. So if it is equity, it will be eliminated through the COC account as well as the NCI account. The difference between the investment and the liability, that 10,000, will be adjusted as under COC account, difference adjusted in goodwill, NCI account, NCI at fair value, difference adjusted in goodwill attributable to NCI, or if NCI at proportionate share of net assets, closing balance of NCI would be adjusted for the difference. Okay. All right. Fine. So for example, we have taken a case of this side. Okay. हमने example इसी का लिया है because I thought that the left hand side financial liability, you are fairly going to be masters in understanding. But equity में थोड़ा सा problem है. If investments are classified as equity, books of P entry will be investment in preference shares of S 60,000. You have purchased 500 shares at rupees 120. In books of S, it is an equity because it is a convertible preference share. So this will be appearing at 50,000. So can you see there is a 10,000 rupee difference? There is a 10,000 rupee difference. Acha. Note number 1 nahi aayega. No impact. Working note 1, there won't be any impact. Okay, what is working note 1? Consolidated other equity. Note number 1 is assets liabilities total. Note number 1, to populate that I need assets and liabilities. This is not asset or a liability. This is equity. So it cannot go in note number 1. It cannot go in note number 1. Is it okay? Yes. Are you understanding why it is creating an issue? Yes. So therefore, ये 10,000 note 1 में तो जाने से रहा. Now coming to cost of control account. Coming to cost of control account and NCI account, how does it look like? Cost of control account, I will eliminate the investment in preference shares. I will eliminate the investment in preference shares because now this becomes my investment in equity, investment in the nature of equity. So 60,000 I have eliminated here. But the preference share capital that will be eliminated is only 50,000. That is the face value. And therefore, my ultimate impact is goodwill increases by 10,000. Goodwill increases by 10,000. If this was a liability, the extra 10,000 would be shown in the consolidated P&L as a loss on settlement. Okay, though the settlement has not happened, it would be like a notional loss on settlement, but it would be a loss nonetheless. यहाँ पे क्या हो रहा है? It just adds up your goodwill by 10,000. Okay. Coming to NCI, what are you going to record? I will record the balance preference shares which are issued as equity. And then ultimately the balance of NCI starts to grow up, starts to grow. Is it okay? Have you understood? Yes, Manini has confirmed. No. Have you understood now? What are you going to do if it is an equity? Okay. See. Simple सी बात है. I have not purchased all the preference shares. I have purchased some of the preference shares. थोड़े से मैंने खरीदे. So that will be to investment in preference shares, nature of equity. अगर मैं, see, you are clear why investment in equity is impacting the split of equity share capital? Are you clear about this? Yes. So if you are clear about this, I am adjusting the equity share capital against the equity shares investment. I gave you 2-3 reasonings for that. First one, I told this is an intercompany balance. So therefore it has to be eliminated. I also told you that equity plus reserves is nothing but the net assets on the date of acquisition, which I have to compare with the purchase consideration. And therefore, following that reasoning also, we will have to eliminate that. Coming to similar kind of assumptions or understanding, investment in preference shares of the subsidiary, which is classified as equity, is a corresponding balance of the preference share capital of the subsidiary. Is a corresponding balance of the preference share capital of the subsidiary. So suppose I had issued 1 lakh worth of preference capital, जिसमें से parent has taken 50,000. then NCI के पास जो शेयर होगा वो भी तो होगा 50,000. Yes. So, like how I used to divide equity capital between the parent and the NCI through the COC account and NCI account, in similar way, I will allocate preference share capital between the parent as well as the NCI. Sir, किस ratio में? Will you allocate it based on this ratio? Answer is no. You will allocate it based on the preference share capital ratio. कि भाई इतने कैपिटल में से how much has gone to the parent and how much has been held by the NCI. So that is the reason we are going to eliminate. And because the preference capital gets eliminated here, my NCI value starts to increase. My NCI value starts to increase. Are you clear now, everyone, how the NCI is impacted on account of classification of these instruments as equity? Yes. Are you clear? Yes. Kaushiki, समझा आपको? Kaushiki, did you follow? Nidhi, did you follow? Yes. If fair value and market value is the same, face value and market value is the same, then also will we credit NCI with preference share capital? Yes, ultimately you have to eliminate. See, understand the flow first. Understand the flow. Note number 1, assets and liabilities, line by line consolidation. Note number 2, equity only of the parent. Note number 3, equity of parent plus the post acquisition profits of the subsidiary. तो ये हो गया मेरा flow. When I come to COC and NCI, what I am eliminating in the COC is the investment in the equity. Against that, all my equity items pre-acquisition are going to get eliminated, which will include these kind of instruments, So even though the face value and market value is the same, for instance, suppose कीजिए ये 60,000 है and face value would be 60,000 only, not 50. If the face value would be 60,000, eliminate it. If we eliminate, ज्यादा से ज्यादा क्या होगा? गुडविल पे कोई इंपैक्ट नहीं आएगा. गुडविल पहले जितना था विदाउट एलिमिनेटिंग प्रेफरेंसेस अभी भी उतना ही आएगा. But what are you doing is you are eliminating the investment in preferences and you are eliminating the preference share capital. That means in the consolidated financial statements, this is not going to appear. This is not going to appear. Is it fine? Have you understood? Yes. Yes. And because I have eliminated a part of the preference share capital in the COC, the remaining part, which is with outsiders, will be credited to the NCI account. Will be credited to the NCI account. Is it okay? Yes. और कुछ पूछना है आपको? Kaushiki, did you follow? Convinced, Kaushiki? Yes, are you convinced? Yes, it is same as investment in equity. Only thing is the name is different. Only thing is the name is different. Okay. Acha, I have another question. Sir, will we give the same treatment for equity component of compound financial instruments? Obviously. Equity component of compound financial instruments has to be allocated between the parent and the NCI, and that will be again on the basis of pre-acquisition and post-acquisition. So that also will be eliminated in the similar manner. Yes, that also will be eliminated in Same similar manner. No doubts, no second thoughts about it. Okay. सिर्फ नाम बदला है, concept वही है. Okay. All right. So that takes care of this part. All right. Okay. We are left with another 2 classes. Okay. The last one for today, let us see. Dividend के बाद acquisition date different from balance sheet date, chain holding, additional stake purchase. Baapre. Okay, fine. Okay. Last one before we move on to the problems. Note on parallel subsidiaries. Okay. See, you have companies like Tata's, Larsen and Toubro, etc., who have hundreds of subsidiaries. Okay. तो उसको हम लोग बोलते हैं parallel subsidiaries. Parent holding in S1, S2, S3, S4. All these entities, parent is holding shares. Okay. And a controlling stake. So if I have to prepare a consolidated financials, it will be parent plus all the 4 subsidiaries put together. So how are you going to do? Well, you will have to calculate the stake in each of the subsidiaries and determine the date of acquisition. Step number 2, add all assets liabilities of subsidiary in note 1. Prepare COC account and NCI in columnar form. By 4 subsidiary है, 4 NCI रहेंगे, 4 values of goodwill or capital reserve रहेगा. So you will be doing that. Net goodwill or capital reserve or NCI will be taken to the consolidated balance sheet. Reserves of each company shall be analyzed separately. Reserves of each company shall be analyzed separately. You don't have to do anything different. Okay, it's exactly the same. It is like 4 questions are put together in a single question. Okay, it's like 4 problems are put together in a single problem to make your life a little more complicated than it normally is. Okay, so that is what is parallel subsidiary. You have chain holding also, which we will look in the next class. Okay, so with this background, question 47 is done. Let us then move on to the next set of questions. Okay, fine. Question number 46 पे आते हैं. Let us come to question number 46. Okay. Come to question 46. This is not there in your study mat. This is picked up from old syllabus, but we have modified it for this. Okay. The balance sheet of Aqua Limited and Baka Limited as on the dates of the last closing of accounts are as under. Aqua Limited is as on date पे ध्यान देना जरा, as on 31st March X7. Baka Limited is as on 31st December 20X6. So what is it? This is different dates of consolidation. Okay. So you are given equity capital, accumulated profits, accounts payable, non-convertible debentures, and other liabilities. Okay. Assets, fixed assets less depreciation, investments, 40,000 shares in Baka, 1,000 debentures in Baka. Current assets, you have inventories, accounts receivable, cash and bank. The following information is also available. On 8th February 20X7, there was a fire at the factory of Baka Limited, resulting in inventory worth 20,000 being destroyed. Baka received 75% of the loss as insurance. On 13th March 20X7, Aqua sold goods costing 1,50,000 to Baka at a markup of 20%. Half of these goods were resold to Aqua, who in turn was able to liquidate the entire inventory of such goods before the closure of accounts on 31st March 20X7, not 17. 20x7. As on 31st March x7, Baka's accounts payable shows to 60,000 due to Aqua on the two transactions. Aqua acquired the holdings in Baka on 1st January 20x5 when the reserves and accumulated profit stood at rupees 75,000. Prepare the consolidated balance sheet of Aqua and its subsidiary as at 31st March 20x7. I've given the reference, old syllabus practice manual question number 5. It's slightly modified for our requirements. Okay, so it's not there in your current study mat. Isko dhundna bhi mat. Okay, all right. So now if I have to do this question number 46. Can I straight away start with this balance sheet and plugging in the values in note number 1? Answer is no. Q no? Because dates of closing year dates are different. Okay. तो आपको क्या करना पड़ेगा? You will have to see Ind AS 110 principles. What it tells, difference up to 3 months hai? Yes, it is there. One is March, one is December. So difference is up to 3 months. So if that is the case, then what are you going to do? We will have to restate the balance sheet of the subsidiary Baka Limited to 31st March, and then only the consolidation will happen with the new balance sheet. Sir, do I have to prepare the entire balance sheet, or is only adjustment to material events sufficient? You will have to restate it only with material events. You will have to restate only with material events. Absolutely right. Sir, material events kya hote hain? Material events are those events which are identified by the management and given to you. अपना बुद्धि लगा के मटेरियल इवेंट प्लीज मत सोचो. ओके, जैसे एग्जाम में आएगा, यू विल स्टार्ट थिंकिंग अरे डेप्रिसिएशन फॉर 3 मंथ्स तो हमने दिया नहीं है. डेप्रिसिएशन का इंपैक्ट आपने नहीं दिया है. इट मींस इट इज नॉट अ मटेरियल इवेंट. इट मींस इट इज नॉट अ मटेरियल इवेंट. ओके, टू ट्रांजैक्शंस मींस वो जो एक आग लग गया ना, आग लग गया और आपके गुड्स खराब मतलब डिस्ट्रॉय हो गए. सो दिस इज फर्स्ट ट्रांजैक्शन. दिस इज द सेकंड ट्रांजैक्शन. ओके, दैट इज इंटर कंपनी सेल जो हुआ था prior to 31st March X7. So these are the two adjustments which we will have to give effect to, because both of them are happening before 31st March. Is it okay? Yes. ये दो ट्रांजैक्शन का इफेक्ट दो, restate the balance sheet. That will be the first step, and then we move on to the next set of workings. Then we move on. Then the balance sheet that we have prepared will be the balance sheet for the purposes of consolidation. Okay, depreciation provision अगर दिया नहीं है, खुद से मत सोचो. Don't think by yourselves. Okay, it's not needed. आपको मैनेजमेंट देगा what are the material impacts. As an auditor, you cannot say what is going to be material. अरे आपको पता ही नहीं होगा 3 महीने में क्या हुआ है. That is what is the management's call to decide what is going to be material for you. Is it okay? Yes. At the most, auditor can perform procedures to check whether after the restatement, is there any material difference in the balance sheets? Okay, so if there is a material difference, then the auditor can question, but otherwise the auditor can never identify what is material in his opinion, because that is the management's call always. Okay, all right, fine. So यहां से तो हम शुरुआत नहीं कर सकते. We cannot start from here. So what we are going to do is we will be starting with working note number 1, restated balance sheet of Baka Limited as on 31st March 20x7 after material events. ये आपका solution नहीं है. This is not your solution. This is only a working note. So it is not needed for you to prepare the whole vertical balance sheet. काम आसान करो, restated balance sheet ही तो है, right? So the main answer you presented in schedule 3 format. ये तो अपना ही balance sheet है. You don't have to do anything special. Okay. All right. So now coming to Baka Limited. Okay. You can, if you want, you can write a note saying that Baka's balance sheet is prepared on 31st December X6, whereas Aqua's is prepared on 31st March X7. The difference is only 3 months, and hence Baka's standalone balance sheet will need to be restated in order to incorporate the material items. Itna likhoge, bas bahut ho gaya. After that, you don't have to do anything. Okay. So now coming to the question, restated balance sheet, Baka Limited, equity share capital is given to be 5 lakhs. So let us write share capital. Okay. Assets 4,05,000. Please don't depreciate. 4,05,000. Okay. Trade receivable, they have not given any adjustment, so we can take it. This is net of depreciation. Okay. Trade receivables 2,65,000. कोई change नहीं है. Let us look at the event that has given a hit. On 8th February, there was a fire. Inventory worth 20,000 destroyed. Baka received 15%, 75% of the loss as insurance. Received means bank में पैसा आ गया. So working note number 2 is going to be loss by fire. Bank account debit. Loss by fire debit to inventory. To inventory. 20,000. 15,000. 5,000. What is this 15? How did I get? 20,000 into 75%. 20,000 into 75%. So that takes care of the first thing, that is loss by fire. Okay. Is this clear, everyone? Yes, loss by fire will go straight away to accumulated profits. Will go to accumulated profits. All right, so just do the postings. Accumulated profits and reserves. Accumulated profits and reserves. We start with 2,05,000. There is a loss of 5,000. All right. We still have another transaction to be recorded. I am having cash bank. So that is 3,05,000 plus we are getting 15,000. Let us see what other adjustments are there. Okay. All right. What else I'm having? Well, I'm having this I recorded, this I recorded. I'm having debentures. 15% non-convertible debentures. 3 lakhs. Acha, there may be some extra enthusiasm among you. Sir, 15% debentures, इसमें हम interest accrued करेंगे. We will accrue the interest for 3 months, show it as a liability and also reduce it from the reserves. उससे क्या हासिल किया? Management has not said it's a material transaction. So you don't have to do that. Okay, you don't have to do that. अगर difference 4 महीना होता, बेशक करो, do it as you wish. Okay, because you have to give the full financials if the difference is more than 3 months. Okay, next I'm having trade payables, other liabilities. Other liabilities, 40,000. 40,000. Okay, cash bank inventory एक बचता है. Okay, 3,50,000. लॉस हुआ था 20,000 का. ओके, लॉस हुआ था 20,000 का. ओके, done. Trade payables 15% non-convertible. All right, fine. Next, we are given intercompany transactions. We are given intercompany transactions. अच्छा, क्या बोलता है? On 13th March, Aqua sold goods costing 1,50,000 to Baka at a markup of 20%. Okay. Cost price to Aqua 1,50,000. Okay. What will be my selling price? At a markup of 20%. Therefore, selling price Aqua is going to be 1,80,000 plus 20%. So selling price is 1,80,000. Therefore, profit generated by Aqua is 30,000. Definitely, as long as it is a working note, you can prepare the balance sheet in this format, but your final answer must be in the vertical format. No excuses for that. Okay, so 30,000. Who is selling the goods to whom? Well, Aqua is selling these goods to Baka at these rates. Okay, so cost, then uske baad kya ho raha hai? So 1,50,000 worth of goods, it is selling at 1,80,000 to Baka. Okay, now the question is, half of these goods were resold to Aqua. Yeah, mazak chal raha hai. Cost price 1,80,000 less cost of goods sold, half of it. 1,80,000 into 50%. So 90,000. 90,000. So I am left with 90,000. What is this? This is the goods sold to Aqua. This is the goods sold to Aqua. So the first leg of the transaction is a downstream one. These goods reach there and then it becomes an upstream transaction. It becomes an upstream transaction. Is it okay so far? Is it okay so far? And then was resold to Aqua, who in turn was able to liquidate the entire inventory. So from here, we will be liquidating the inventory, that is outsiders. That is outsiders. Is it okay? Is it okay so far? Manini has confirmed. What about the others? Rashmi. Okay, all have confirmed. Now what I want you to tell me is, okay, I want you to tell me cost price to Baka. By this is 50%. So 1,80,000 ka 50% is 90,000. What I want you to tell me is, what is the selling price at which Baka is transferring these goods to Aqua? What is the selling price at which it is transferring these goods to Aqua? Nidhi, Shailendra, Sumit, Kaushiki, Srishti, Manini. Please tell me. Selling price कितना होएगा? How are you saying it is 90,000? How are you saying 1,20,000, Sumit? Okay, fine. No problem. Not able to calculate, don't worry. I think I have asked them to show. I think it's difficult for them to show. Okay, all right, no problem. See, books of Baka. Let us prepare Aqua Limited's account. Okay, now let us see. I am purchasing. See, Baka is purchasing goods worth 1,80,000. So credit by purchases 1,80,000. By purchases 1,80,000. Next, what other data are you given? As on 31st March X7, Baka's accounts payable show 60,000 due to Aqua to balance carried down. Okay. Is there any payment which is made by Baka to Aqua? No. तो फिर ये 1,80,60 कैसे हो गया? Those goods which are being transferred, no? ये जो goods जा रहे हैं 50% of the goods are being transferred from Baka to Aqua. That selling price is what is the difference? To sales. 1,20,000. 1,20,000. So if I come here, what is my selling price? My selling price is 1,20,000. Therefore, profit Baka 30,000. Profit earned by Baka 30,000. Are, have you understood this? Is it clear? Okay. सुमित, आपने भी ऐसे ही किया था या दूसरे तरीके से किया था? Okay. Understood. Okay. Now see, these goods are ultimately sold to Aqua and from there they are sold to outsiders. That means ये तो हो गया इसका adjustment. Now I'm talking consolidation. These goods from the parent they went to the subsidiary. Okay. Subsidiary से 50% came back to the parent. Okay. And then that what came back to the parent is sold to the outsiders. So now you tell me, what is the impact? Can I say impact is net balance 50% goods are remaining with Baka? Can I say that balance 50% goods are remaining with Baka? Yes or no? Yes. So in respect of that balance 50%, we will be calculating the unrealized profit at the time of consolidation. We will be calculating the balance unrealized profit at the time of consolidation. Okay. Is it fine? Yes. तो ये हो गया मेरा first part. Since these goods, this 50% which are sold to Aqua is sold to outsiders, can I say that there won't be any unrealized profit? There will be a realized profit from the group perspective as far as these 50% goods are concerned. So therefore, there is nothing for us left to reverse as far as this transaction is concerned. So what is happening to Baka's balance sheet is inventory is increasing by 90,000. Number one. Trade payables are increasing by 60,000. Number two. And profits are increasing by 30,000. Number three. These are the three impacts on Baka's standalone financial statements. These are the three impacts on Baka's standalone financial statements. Okay. So let us record that part now. Let us record that impact we can write here on Baka's standalone financial statements. Inventory $90,000 debit increase. Trade payables Trade payables 60,000 credit. Profit 30,000. Yes. वो कैसे आया प्रॉफिट? 1,20,000 minus 90,000. 1,20,000 minus 90,000. Is it okay? Yes, is it okay? All right, so do the postings. Trade payables. What is the existing balance? 2,80,000 plus 60,000. So this comes to 3,40,000. 3,40,000. Inventory has gone up by 90,000. So this comes to 4,20,000. 4,20,000. Cash bank, no further adjustment, 3,20,000. Accumulated profits and reserves went up by 30,000. 2,30,000. 2,30,000. Have you understood the impacts of all the major items now? Have you understood impact of all the major items? So this tallies at 14,10,000 and this is also 14,10,000. This is also 14,10,000. All clear? Yes, Kaushiki. Nidhi, did you follow? Rashmi, did you follow? Yes. Manini, we will be cancelling unrealized profit in the consolidated financial statements. यहाँ पे हम consolidated नहीं बना रहे. This is just a restated balance sheet of BACA. This is not consolidation. So what unrealized profit you're talking about, that will be cancelled when I do the consolidation. As of now for BACA Limited, actually the cost price is the selling price of the parent Aqua Limited. So in its standalone, it has to take that as the selling price without deducting the unrealized profit. Okay. So that adjustment will come on consolidation. आएगा वो. Yes. Okay. तो ये हो गया मेरा balance sheet. And this will be the balance sheet that will start forming the basis of your consolidation. That will start forming the basis of your consolidation. Okay. So we take a 10-minute break. Okay. We take a 10-minute break and then we shall continue with the question. I finish this question and then on Thursday we do the dividend and bonus shares adjustments. Then we'll be left with stake sale, stake purchase, which we should be able to wind up on Saturday. Okay. All right. We take a 10-minute break. It's 9:04. We shall resume at 9:15. I'll give you the main pointers for this so that you can complete the balance sheet at home. All right. 10 minutes break. Nisarg? Okay. All right. Welcome back, guys. So I have a couple of questions. One is Sumit's working. Let me check his working. $90,000 into 50 by 150. Goods costing. How did you get 50 by 150, Sumit? बता सकते हो ये 50 by 150 कहाँ से लिया आपने? Okay, then I can tell you whether it is right or wrong. I need to understand that. Okay. All right. Fine. So we now start with the consolidation process. Okay. Now you forget this balance sheet as far as Baka Limited is concerned. Baka का ये balance sheet हमारे लिए relevant नहीं है. You have prepared the balance sheet of Baka, the restated balance sheet. We will be proceeding with that. Okay. So now coming back to our usual consolidation process. Yes, this is the balance sheet of Aqua and then Baka Limited and Aqua, the consolidation notes. Aqua Limited will come from the question. Baka Limited is going to come from working note number 1. Is going to come from working note number 1. Okay. All right. Where have they given the margin as 50%? They have told half of these goods were resold. This is the quantity. This is not margin. Okay. This is the quantity. Half of these goods were resold to Aqua, who in turn was able to liquidate. Where is the markup given? The markup is not given anywhere. No, Sumit? हमें तो दिख नहीं रहा है. बता देना, ठीक है? So let us go on populating the figures. Property, plant and equipment straight away from the question as far as Aqua is concerned. This is 6,50,000. Investment in debentures, we'll write it separately because it is an asset requiring elimination. So 1,50,000. Next one, we are having inventories, 2 lakhs. Then I am having trade receivables. Trade receivables 1,50,000. Then I am having cash and bank 80,000. Trade payables भी है 3,80,000. Other liabilities 2 lakhs. Okay. Debentures ये नहीं है. वो 50% margin था नहीं. So I don't think how, means I don't understand from where you took that. Okay. इसके लिए. All right, fine. तो ये हो गया मेरा Aqua. Now coming to Baka. Baka के लिए we'll look at the question that you have prepared. So property, plant and equipment 4,05,000. Trade receivables 2,65,000. Okay, 4,20,000 inventory, cash bank 3,20,000. So just populate it from here. Property, plant and equipment 4,05,000. बाका का खुद का कोई इन्वेस्टमेंट नहीं है. Inventories is 4,20,000. Cash and cash equivalents 3,20,000. Sorry, this is trade receivables 2,65,000. Cash and cash equivalent 3,20,000. And then other liabilities 40. Debentures 3 lakh, trade payables 340. 40, 3 lakh 40, and debentures are at 3 lakhs. Debentures are at 3 lakhs. Okay. So that is populating it entirely. Okay. Aqua from the question, Baka from working note number 1. Equity share capital as always will be of the parent. So parent के कितने shares हैं? 10 lakh rupees, 10 rupees each. So 1 lakh shares. So 1 lakh equity shares. 1 lakh equity shares of rupees 10 each, fully paid. So that is 10 lakhs. Okay. So pull this value in your equity share capital. This is note number 2, 10 lakhs. 10 lakhs. Okay. Next, we start with note 2. Consolidated other equity mein you will be having consolidated accumulated profits and reserves. From working note 4. From working note 4. So working note 4 will start with standalone Aqua Limited. एक ही item of reserves है. Standalone Aqua Limited is 4,50,000. 4,50,000. Okay. All right. Now coming to elimination of investments, I will be eliminating this because this is in the nature of liability for the counterparty. Liability for Baka. This is not in the nature of equity. So we will eliminate 8 lakhs. So to investment in Baka Limited equity shares. How much is the value? 8 lakhs. We will eliminate this 8 lakhs. Okay. So right now what all we have considered is 8 lakhs, 2 lakhs, 150, 80,000. We have considered this, we have considered this, this, and this. Okay. And from here, nothing, it's all gone from there. That is the working note which we have prepared. From there, we have included 40,000, 4 lakh 20, 3 lakh 20, 265, 4 lakh 5, 3 lakh 40, 3 lakhs. So what is left is accumulated profits and reserves, share capital. That is what is applicable. That is what is left for analysis now. So now coming back to our solution. 8 lakhs we have eliminated. We are now left with this 1 lakh 50. This is in the nature of equity. This is in the nature of equity. Since it is in the nature of equity, sorry, this is in the nature of liability. Since it is a liability for Baka, I cannot eliminate it in the COC account. So it will be eliminated in note number 1. It will be eliminated in note number 1. Okay, so we can just write a quick journal entry for that. Okay, although it's not needed, but still I will just write it here. Okay, to investment in debentures, this is eliminated. The liability stands to get eliminated. Debentures account debit. 1,000 means it is 1 lakh. That means the difference of 50,000. What is this? This is your loss on elimination. This is your loss on elimination. This loss on elimination will be recorded where? This will be recorded in the consolidated P&L. Okay. So debentures will go in note 1. Investment will also go in note 1. This will go in note number, sorry, not note, working note 4. In this question, working note 4 is the consolidated, what you can say, consolidated reserves का जो working है, because we have working note 1 the balance sheet, working note 2 that insurance, working note 3 was that intercompany transfers जो हुए थे. So working note 4 is the loss on elimination, which goes as a part of consolidated reserves working. So let us proceed to eliminate these balances now. From investment, I will eliminate entire 1,50,000. But against this, I can eliminate only 1 lakh in my debentures because that is the face value. So this will be 0, whereas this will appear at 2 lakhs. And the balance 50,000 extra which I have paid, that I will be eliminating against the consolidated reserves. So loss on elimination of debentures, intercompany, intercompany. So this is 50,000. This is 50,000. Are you clear? Yes. So far, everybody understood, or am I rushing too fast? Right now, I have not. This is the first working note only which I have done. Otherwise, it's just populating the balances. Have you understood? Yes. Okay. So that takes care. All right. Achha. What is my holding percentage now? I am holding 40,000 shares out of 50,000 shares. Okay. So that is 80%. Okay. Fine. 80% stake. If you want, you can put a star here and somewhere below the COC account, you can write 40,000 divided by 50,000 into 100. So that is 80%. Okay. There is no space here. I don't know why there is no space. There should have been space. Okay. All right. So that takes care of the stake. So NCI will be 20% stake. Fair value is not given. So we will be following proportionate share of net assets. Proportionate share of net assets. Okay. So let us split the equity. Equity was 5 lakhs. So by equity share capital, this is of Baka obviously, 5 lakhs into 80%, that comes to 4 lakhs. And here by equity share capital, 5 lakhs into 20%, that comes to 1 lakh. Okay, so that is done. Then we start with the major working, 7, that is analysis of reserves, and 8, inventory adjustment. Okay, so accumulated profits and reserves already लिखा हुआ है is equal to 2,30,000. कहां से मिल रहा है ये बैलेंस शीट? नॉट दिस बैलेंस शीट, नो, इट शुड बी दिस बैलेंस शीट विच वी हैव इतने मेहनत से ब्रेक से पहले हमने किया था. 2,30,000. तो हमने सब ले लिया. सो वी स्टार्ट अप विद दिस 2,30,000. Okay, from working note 1. Okay, now this we will have to split it up. Pre, post. Pre and post. Okay, so now when I go ahead and split it up, how am I going to do the split? Am I given the balance sheet reserves position as on the date of acquisition? Yes. Aqua acquired the holdings when reserves and profit stood at 75,000. So up to 1st January 20x5, 75,000. After 1st January 20x5, obviously it is the balancing figure, 1,55,000. This is, you can write in bracket 2,30,000 minus 75,000. Okay, तो ये हो गया मेरा पोस्ट, ये हो गया मेरा पोस्ट. Okay, all right. Now coming to these profits. Okay, what is the story of the intercompany unrealized profits? Aqua has first sold goods to Baka. Okay, Baka has sold half of those goods to Aqua and Aqua has sold it to outsiders. So that half I am not worried. What I am worried about is the balance half which is there with Baka, Okay, so 50% remains unsold, and in respect of that 50%, there is a profit markup. Let us look at our initial working. 1,50,000 sold for 1,80,000. 30,000 is on 100%. 50% came to Aqua and went to outsiders. So remaining profit that is there is 15,000, as Manini had also said. So this 15,000 we will now end up eliminating. This 15,000 we will end up eliminating. It is profit sold, profit on account of sale from the parent to the subsidiary. So this is an upstream transaction. This is going to be a downstream transaction, parent to the subsidiary. So entry will be P&L of the parent company debit, that is consolidated P&L, to inventory of the subsidiary. In respect of the upstream transaction, Baka selling 50% of those goods, that is this 30,000 profit. This 30,000 profit I will not eliminate because it's already sold to outsiders. So we will have two notes, one for the downstream transaction where elimination happens, and one for the upstream, which will explain why the elimination will not happen. Okay, so once that is done, I think the problem is over. So come to your inventory adjustment, unrealized profit elimination. First one, downstream transaction. Downstream transaction. Profit on downstream sale, rupees 30,000. 50% of goods are resold by Baka to Aqua, which is ultimately sold to outsiders. Therefore, balance 50% goods only are in stock with Baka Limited. Therefore, profit to be eliminated is equal to 30,000 into 50%, 15,000. What is the entry? P&L Aqua Limited debit to inventory Baka Limited. 15,000. So this is going to be working note 4 in this question, and inventory will go in note number 1. So this will be eliminated. Okay. So have you written, guys? Yes. I trust you have written this. So we proceed further. 15,000. Let us do the elimination. Less unrealized profits on inventory. 15,000. 15,000. And then we will be eliminating it from inventories as well. We will be eliminating it from inventories. Okay. All right. So that comes to minus 15,000. 15,000. All right. Next. That downstream we'll just write a note, because tomorrow when you guys revise, I don't want you to be in confusion that, sorry, downstream nahi, ye hoga upstream. Upstream transaction. Goods sold by Baka Limited to Aqua Limited. Are ultimately sold to outsiders. Therefore, profits of rupees 30,000. 30 कैसे आया था? 1,20,000 was the selling price. 90 was the cost to Baka. Therefore, profits of 30,000 need not require elimination. So no adjustment to this. No adjustment to this. Okay. All right. So that takes care of that. Okay. So coming back to our working, all is done. Start to split up the profits. Aqua, NCI. Aqua, NCI. 80, 20. 80, 20. So this is 15,000. This is 60,000. This is 31,000. This is 1,24,000. COC account, NCI account, consolidated reserves, NCI account. In this problem, this is working note 5, working note 6, working note 6, working note 4. Give the impacts. Aqua credit in the COC by pre-reserves 60,000. NCI credit by pre-reserves 15,000. This is working note 7. Working note 7. NCI post reserves. Working note 7. 31,000. Yes. Excuse me. So that is done. Non-controlling interest is done. Balance the COC account. And here you will write add post acquisition profits. Working note 7. 1,24,000. 8 lakhs. 3,40,000 by goodwill. By goodwill. Balance NCI 1,46,000, which is going to be to balance carried down. 1,46,000. Okay. Total up this part 4 lakh 524 5,09,000. So consolidated reserves is 5,09,000. Okay. Then there is a balance. If you look at the words, 60,000 due to Aqua. So we will be ultimately eliminating that as intercompany trade receivables, trade payables. Okay, so since that is eliminated, now let us take the total 10,55,000, 620, 6,05,000, 3,55,000, 4 lakhs. This is 2 lakhs. 680. Sorry, not 680. 660. 6,60,000 and then 2,40,000. 2,40,000. Okay, so that takes care of everything. Yes, all parts are done. So if you now complete the balance sheet by just have to do a posting of the figures, your balance sheet should tally at 27,55,000. सब कुछ मैंने कर दिया, इतना तो आप श्योरली कर सकते हो. Just put these figures in the balance sheet. You should be able to get the balance sheet tallied at 27,55,000. Okay. Can you do this for me? Yes. Can you do it for me? See that 60,000. Look at this. They have told that Baka's accounts show 60,000 due to Aqua. So it becomes intercompany receivable payable. So if it is payable to Aqua, obviously in Aqua's books, it would be receivable from Baka. So 60,000 we eliminated from both the sides. Okay. So that takes care of all the adjustments, all the effects. Yes. So it was a good question. It was a good question. I will be discussing a couple of things on this in the next class as far as the inventories are concerned. See, this is the question is done. Question is done, but there will be a couple of other things as far as the inventory is there. So some extra parts. So we will discuss it in the next class before heading forward. Okay. Next class is going to be very, very important because next class I will be doing 2 or 3 very important adjustments. That is dividend adjustments. Okay. That is dividend adjustments. So if possible, don't avoid next class. Okay. Those who are there, those who are not there, if you are watching it on a later time, please watch it along with us because we will be doing the next most important adjustment, that is the dividend adjustment. Okay, so try to complete this balance sheet and we will resume on Thursday. Thursday we should be completing dividend and the other one, that is your bonus. Okay, that much is my target. So then stake sale, stake purchase, we can do it on Saturday and conclude consolidation. Okay, so see you guys, do this, complete the posting. Any doubts, any clarification, criticism, any change, space, speed, clarity, everything is fine? Yes. Okay, tata, bye bye, see you. Go to your office or continue studies. Okay. Next year, next 6 months, by this time, you will be having your results. Okay. Today is the CA final results. That is if your attempt is in the next, what is May, then you will be there. Okay. So see you guys. Thank you, everyone. Thank you. Thank you. Okay. Nisarg. Nisarg. हो गया, done.